In San Francisco, this is Bloomberg Technology. Coming up in the next hour, listening in. Mark Zuckerberg's meeting with Facebook employees gets leaked, why the social network CEO is ready to go to the mat against the U.S. government. Plus, back in Brazil, Uber is re-entering Brazil's slums. But can it keep drivers and riders safe this time around? We'll look at its plans for the favelas and the opportunity that awaits. And VCs and executives from hundreds of private companies will meet in Silicon Valley this week to discuss whether the financial industry system for IPOs is working. Could there be an easier solution? But first, our top story. Facebook CEO Mark Zuckerberg is ready to take on the U.S. government if Elizabeth Warren wins the presidency. This is from leaked audio obtained by The Verge of Zuckerberg during a July meeting with employees.
Like Elizabeth Warren, who thinks that the right answer is to break up the companies, if she gets elected president, then I would bet that we will have a legal challenge, and I would bet that we will win the legal challenge. Does that still suck for us? Yeah. I don't have to, have a major lawsuit against our own government. That's not like the position that you want to be in when you're, it's like we care about our country and want to work with our government to do good things. And but look, at the end of the day, if someone's going to try to threaten something that existential, you go to the mat and you fight.
Zuckerberg also spoke on a lot of other topics, including Facebook's proposed cryptocurrency, Libra, and its competition with Chinese-based video app TikTok. Joining me to discuss in Washington, Carl Szabo, General Counsel for NetChoice, their lobbying group that represents big tech companies like Facebook and Google. And in studio with me, Sarah Fryer, who covers Facebook for us. So, Sarah, just first give me your reaction to what we heard from Zuckerberg saying they're ready to fight.
Well, Zuckerberg has had pretty good luck in his fights with the government so far. If you think about the ways he's testified in front of Congress, nothing really came out of that. He had a $5 billion FTC fine this year, which is just a slap on the wrist in many respects. He's had a pretty good track record of coming up against the U.S. government and winning. So it isn't surprising to me that he thinks that it would totally suck, in his words. But also a little bit surprising to be declaring victory so soon before it happens.
Yeah, Carl, let me bring you in here. From your perspective, how concerned are companies like Facebook and big tech when they think about a person like Elizabeth Warren getting the presidency?
Yeah, thanks for having me here. What you're seeing is Mark Zuckerberg being very excited and being very transparent in his discussion about what's going on. Now, there are a lot of businesses, not just in the tech sector, but across the entire spectrum, that are worried about the notion of just being broken up because they're big. And what you're seeing here today is Mark Zuckerberg talking about the rule of law and the fact that under the existing rule of law, the government just doesn't have a case to bring against Facebook.
And Carl, how prepared or not prepared are these companies to take on what could be a serious legal challenge?
I think all these businesses look back over the past decade, seen what's gone on, what's transpired, and they are fired up. They are ready for an enforcement action against them, and they've got great legal standing, they've got great attorneys, and more importantly, they've got the rule of law on their side.
Sarah, it was really interesting that Carl brought up the word transparent. What was your take on Zuckerberg once this was leaked, promoting it and being fully transparent on Facebook and saying, okay, here it is, here's the whole thing, and posting it on Facebook?
I think he really has no other choice. Zuckerberg has had a lot of gaffes over the years, and he's been asked to testify by many governments, and he's said no. He said no to anyone sort of beyond. He testified in the U.S. and then he testified in Europe, but there have been a lot of questions about whether he'll come to the U.K., whether he'll go again to Congress. And this is a way to say, look, this is how I am when I'm raw, when I'm not, being turned into memes because of the way I sip water, and the under the camera in front of congressional testimony. This is how he is in front of his employees, and you can tell that he's so much more natural that way. He does this every week. They film it, they send it to all the employees, everyone can watch it over the weekend. It is really a tradition there, it's very interesting to see him in his element.
And when you look at the company, does this sort of rally the troops, if you will, or does this hurt morale when leaks like this, of meetings that, like you say, happen on a weekly basis, are exposed?
This is the first time I can remember that a whole audio transcript of a meeting has been released. So it does speak to the tension within the employee ranks, that a lot of the employees aren't sure if they're working for a company that is on the right side of history, and they are questioning him. You see in the transcript that they ask him about his voting power several times, and sort of challenge his authority at the top of Facebook. And he responds by saying, referring to something that happened in 2006 as the reason why he's allowed to keep authority, the fact that he turned down the $1 billion acquisition offer from Yahoo. So it's very interesting to see how he goes up against those questions over and over.
Carl, to be fair, I want to bring in a tweet that we also got from Senator Elizabeth Warren in response to this, and my team here will pull it up. She says, quote, "It's a corrupt system that lets Facebook engage in illegal anti-competitive practices. They continue to fumble their responsibility to protect our democracy." What do you think of Elizabeth Warren's response?
I mean, there's a lot to unpack in that question. Whether it's anti-competitive, well, it's hard to say that there's no competition when you see Mark Zuckerberg expressing internally that they're worried about competition from new market entrants like TikTok. On privacy, I mean, they just had a $5 billion settlement with the FTC, which I've said before, the FTC was lucky to even get that out of them. And with respect to protecting our democracy, I mean, we're here on Bloomberg TV. I don't think Michael Bloomberg is going to use this network to change the outcome of the election any more than I expect Mark Zuckerberg to use Facebook. So I think that Senator Warren is just throwing a lot of stuff at Facebook and hoping that maybe that helps her in the polls.
Carl, I want to bring up another audio clip that we have that The Verge, of course, did obtain in this audio recording here. Take a listen.
It's just that breaking up these companies, whether it's Facebook or Google or Amazon, is not actually going to solve the issues. And, it doesn't make election interference less likely. It makes it more likely because now the companies can't coordinate and work together.
Carl, your reaction to Zuckerberg saying that breaking up big tech, whether it be at Facebook, Amazon, or Google, doesn't actually solve the problem. It makes it harder to regulate because instead of one big company, you have 20 companies.
Well, it's not just only a matter of regulating 20 different companies. Let's keep in mind that there are over a dozen different government agencies that have oversight over the tech industry. But it's also the notion of having a centralized place where platforms can figure out what content is spam, what content are bots, what content is coming from overseas, and then in a more comprehensive fashion, address those problems. So that's what I think Mark's talking about here. Since Facebook is rather large, they do have the financial backing and the ability to see many different points of attack so that it can better prepare and protect American interests and American democracy.
And Sarah, talk to me about Facebook's argument, really, and I've heard this from several experts that
over and over, this argument that being bigger helps them solve the problems more efficiently and with better resources. I just don't really buy it. I think that if you're Facebook and you have all of these different services, certainly you can say if you're finding this problem on Instagram, you might find it on Messenger too, and you might find it on WhatsApp. But there's also some collaborations they've done with companies outside of Facebook. They have this Atlantic Council to take down terrorist content, and they share this terrorist content amongst themselves. They do the same thing with child exploitation content so that all the companies can take it down at once. And so if the companies were broken up, you could easily have that same kind of arrangement where they all share information broadly.
And Sarah, I want to pivot quickly here a little bit to competition, because Carl brought up the very smart point of competition and Facebook internally talking about TikTok, which is, a social media and sort of a video platform. And Facebook is responding to that competition by developing, I believe it's Lasso. Did we learn anything new today about that product with these leaked recordings?
It's really interesting that Zuckerberg wants to try to push Lasso in countries where TikTok is not yet big. And I also found it interesting that he sees TikTok as sort of like Instagram Explore meets Instagram Stories, and that he's going to try to shift Instagram in that direction. Look, he's tried this many times over the years, copying products, trying to push them out to a similar user base, but we really haven't seen that really take hold except for with Instagram Stories. So it's always a shot in the dark. We'll see if it works, but it's very interesting that TikTok is the new existential threat on the competition side for Facebook.
NetChoice, Carl Szabo, and Bloomberg's Sarah Fryer, thank you both for joining me. Now, Sony has cut the price of its PlayStation Now video game service in half. The new price of $9.99 a month now reflects the increasing competition online. Sony also said that it's adding limited runs of top-selling titles such as Grand Theft Auto 5. Sony is the industry leader in video games. And coming up, fast fashion favorite for millennials, Forever 21 has filed for bankruptcy. Is that in part because fast fashion has moved to the e-commerce realm? We discuss next. This is Bloomberg. The millennial mainstay Forever 21 has filed for bankruptcy. The fast fashion retailer says it obtained $350 million in financing to help it stay afloat. But the bankruptcy shows another sign of the punishing pressures of the broader retail apocalypse, in which the rise of e-commerce is siphoning away shoppers from brick and mortar chains. Joining me for more from Washington, Bloomberg opinion columnist Sarah Halzak. Sarah, when you take a look at Forever 21, did they just not keep up fast enough with e-commerce and their online retail presence?
Yeah, that's certainly a part of what happened here. They said e-commerce comprised 16% of their sales in the court filing, and that would be a lower penetration than we see for the apparel business overall. And you just don't have to look that far to see the companies that are sort of eating Forever 21's lunch in this space. I think Fashion Nova is a great example of that. They were an early pioneer to sort of building a fast fashion brand that was tailored from Instagram from the start. And I think that Forever 21 has suffered at the hands of brands like that.
You mentioned Instagram. Talk to me. How has social media and Instagram changed the way the marketing really these fast fashion retailers can or can't survive?
Yeah, so I think a lot of these retailers have had to partner with influencers, of course. And again, Fashion Nova has gotten the likes of Cardi B and Kylie Jenner, these huge names with millennial and Gen Z consumers to hawk their products on Instagram. And Forever 21 maybe has had a little bit less success in that realm. Instagram is also, rolling out features like shoppable posts that all of these brands have to try to figure out how to master and keep up with. And look, it's important for any retail brand to understand that ecosystem, but especially for one like Forever 21 that courts a teen shopper, it's just really, really important.
So we know the story with Forever 21. A 16% penetration rate online simply in this day and age does not cut it. Enter Stage Right, and you have e-commerce subscription models. You have companies like Rent the Runway. The list goes on, really disrupting this market. What is the difference, like a Stitch Fix, a subscription-based model, a Rent the Runway? What are they doing to disrupt the market?
Yeah, so Stitch Fix, I think in particular, is really a data play. So they are trying to amass all this data on their consumer, and they've sort of built their brand from the beginning on that idea that they're not just sort of thinking of merchandising as an art, but as a real science. And so thinking of everything from the measurement of a sleeve to the aesthetic of a particular garment, all of that is based on feedback that they're getting from customers from these boxes. And so the theory is that they're going to be able to manage their inventory in a smarter way and just create a more pleasing experience for customers over the long haul. Fast fashion has sort of been more of a let 1,000 flowers bloom model. A company like Forever 21 is getting 5 shipments a week to its stores of garments, and some of them are going to be hits and some of them are going to be misses. Definitely these upstarts like Stitch Fix are bringing something new to the game.
And Sarah, are these idiosyncratic stories, or is this a general theme that you have to be, like you said, more now science-based, data-based in order to succeed in this ever-competitive market?
So there's definitely idiosyncratic things about Forever 21. They overexpanded their stores way too quickly. They had stores that were huge, right, that were 35,000 square feet and maybe only needed to be 10,000 square feet. So those are things that are sort of specific to the decisions that they made. But to me, there's no doubt that data is going to play an increasing role in how you market to consumers and how you buy your inventory, and even your merchandising decisions in your stores and on your website. And I think we're still at this place right now where retailers have a lot of data and they don't know how to harness it. And the ones that figure out how to actually use it and make it actionable, those are going to be the ones that win.
Well, data and science finally entering the retail world. Sarah Halzak of Bloomberg Opinion, thank you for joining me. And coming up, Uber has been missing from Brazil's favelas for years, but now it's coming back. Can it keep riders and drivers safe? We'll discuss next. This is Bloomberg. Sao Paulo in Brazil is Uber's biggest market worldwide. That's in terms of the number of rides. But for years, the ride-sharing company avoided the city's poorest regions, the favelas. The reason? The safety of both Uber drivers and passengers. But now it's making another attempt to bring ride-sharing back to those areas, and it's launching a pilot program that it hopes will keep anyone needing an Uber safe. To tell me all about it, I head down to Sao Paulo, where Bloomberg's Fabiola Moura is standing by. She wrote about this in the latest issue of Bloomberg Business Week. Fabiola, thank you for joining me. And for classic Bloomberg size and scope, tell me, what is the importance of Sao Paulo and Latin America to Uber?
Greetings from São Paulo, Taylor. Actually, São Paulo is Uber's largest market in terms of rides. They also told me that 2 other large cities in Latin America, Mexico City and Rio de Janeiro, are among their top 5 pretty often. So it's a very significant market for Uber.
Fabiola, this is not Uber's first attempt to come back into these favelas. What are they trying to do differently now to make sure it goes better than how it did a few years ago?
Yeah, indeed. When they started operating in São Paulo in 2014, they were very aggressive in expanding all over the city. And a couple of years later, a wave of violence against their drivers led to at least 16 deaths. Though Uber doesn't confirm these numbers, they're pretty scary, right? And this time around, they decided to partner with a local entity that fosters development inside these poor neighborhoods and assess the whole region and design pickup points to make sure drivers and riders are safer around the favela and not necessarily getting into its, tiny streets, poorly illuminated and often dangerous.
And is that strategy working? Do drivers and passengers feel safe?
According to the drivers and passengers that I talked to, yes, they feel much safer, including drivers from inside these communities. And, there are large communities. In Brazil, at least 10 million people live in the favelas. And they circle around these communities, inside these communities, $20 billion per year, Taylor, for you to have an idea. So it is an important market, and it's growing pretty fast. Just last week, there was a renewed wave of violence against Uber drivers, not just Uber, but other apps as well. So they still need to assess if this is the right approach or not, but it seems to be working well.
Well, and one of the other approaches you were discussing is working with local development authorities, local people on the ground. Is that how they were accepted back into these favelas? Is that the right strategy this time?
Yeah, they were much more careful this time. So they were talking to the local residents. They were understanding what's the culture of this specific favela called Heliópolis. So they sponsored soccer matches and arts events. They were in depth in this community to understand their needs, and they also had a fair to help them gather more drivers from inside this community. So the community is pretty happy. I've talked to a fruit seller who has a stand right in front of this pickup point that Uber installed. It's a physical pickup point with Wi-Fi and benches, something I haven't seen in other areas, at least here in São Paulo. And he said his business is doing pretty well since this pickup point was installed there. And all the riders that I talked to said it was much tougher before to get an Uber in a favela. So it seems to be the right way.
Well, an amazing on-the-ground reporting. Thank you. That was Bloomberg's Fabiola Moura in Sao Paulo. Thank you for joining me. Now I want to go over to today's top tech calls. Shares of Apple closed on Tuesday within striking distance of record levels as optimism grew that the company's newest iPhone models were seeing strong demand. CEO Tim Cook said that sales of the iPhone 11 had seen a very strong start and that he couldn't be happier with the launch. Shares Tuesday closed at $224 a share, below the record reached about a year ago of $228. And KeyBank Capital Markets upgraded a trio of semiconductor stocks, writing that while broad-based demand remains weak, the industry had found a true bottom. Analog devices, microchip technology, and NXP semiconductors were all raised to sector overweight from sector weight. The analysts at KeyBank said that for the first time in several quarters, we are not seeing demand trends getting worse. And finally, analysts at MoffettNathanson raised the price target of Snap to $14 a share from $11, citing strong user trends in the company's third quarter. This set Snapchat's parent company up for another massive beat. Analyst Michael Nathanson said that while there had been concern about a recent spike in users driven by the viral success of its face swap photo filters wouldn't be sustained, it does appear that Snap has not only maintained a firm grasp on these users, but has grown its base even further. And coming up, it's been a tough year to go public, while Silicon Valley investors are meeting to discuss redesigning the whole process. This is Bloomberg. This is Bloomberg Technology. I'm Taylor Riggs in San Francisco. Silicon Valley is looking to disrupt the IPO business. Venture capitalists and corporate executives are meeting Tuesday in the Tech Hub to discuss whether the system for public offerings is still working. This is after a year in which many of the biggest deals flopped. One possible alternative, direct listings. To discuss, I'm joined by Bloomberg's Shanali Bossack and Bloomberg Technology's Olivia Carville. Shanali, let me start with you. Basically, what are we looking at during this tech IPO summit that's going on today?
So there's a lot here going on about the direct listing model in particular. Obviously, we've had two very big ones, Spotify last year and then Slack this year. Slack's went a lot more smoothly, and Airbnb, now we've reported, is considering one as well. And so this is a model that is becoming much more commonplace. And so who do we have at the event today? We have not only venture capitalists, but hundreds of privately held companies and their executives were invited as well to consider this model, and lawyers as well as market makers, president of the New York Stock Exchange, a lot of people who are able to make this model happen.
And Shonali, what is the issue at stake? Because I can't wrap my head around it. Is it overvaluation? Is it too high investment fees? Is it the fact that a lot of the IPOs haven't done well? What are they so concerned about with the IPO market?
Well, listen, from the venture capital community, for a very long time, they haven't liked the fact that there's an IPO pop because it means that there's money left on the table. And remember, this is not the same for everybody. If you're a major investor and you get invited to the IPO roadshow and buy into an IPO the night before, then you like that pop, right? You like that you bought in a little early. So venture capitalists like the direct listing model because presumably it's a little bit smoother into the IPO. The market sets the price rather than a small group of investors. And so what they are citing, and actually right now, if we think about what's happening at the Palace Hotel right now, we have Jay Ritter, who's the University of Florida professor that did a lot of research about what they call a systematic mispricing of the IPO model, about 30% on average from Goldman Sachs, Morgan Stanley, and JP Morgan.
Olivia, talk to me about the differences between the IPO market and the direct listing. If you're a company that needs to raise new money, we know that you probably need to IPO because a direct listing doesn't actually give you new cash, right?
Right, correct. So the difference here with a company like Airbnb, for example, they have a private valuation of $31 billion. In the last quarter, they pulled in more than $1 billion in revenue. So they're in a position where they don't actually need to raise any additional capital. And that's one of the points of difference here with a direct listing to an IPO, is you don't issue any new shares and you don't raise any additional capital. So for Airbnb, it could be a benefit to go down this road because not only do they not have to deal with raising the additional capital, they don't have to deal with the traditional IPO roadshows, speaking to those institutional investors, and it can be seen as a more streamlined or kind of a simpler process to access the public markets.
Olivia, specifically with Airbnb, we thought they might IPO. We're hearing rumors perhaps they might or are considering a direct listing. Specifically with Airbnb's case, why direct list?
Well, there are a few things that we can talk about here with Airbnb. One of the benefits for them would be the fact that they don't need to raise that additional capital, as I was saying. Another issue with the company at the moment is that they have employees or long-time employees who are really keen on cashing out. They want access to that money, and in order to do so, the company needs to go public. With a direct listing, you're listing your shares directly onto a stock exchange without going through that traditional IPO route. So the company would be able to, in a way, sidestep Wall Street, and it would avoid some of those underwriting fees, but they're also allowing those insiders to cash out.
Shonali, what's the key takeaway? Do direct listings start to take up a bigger proportion relative to IPOs?
The IPO market is still a huge market, remember, and it's far beyond even just Silicon Valley. Remember, international firms like to list in the US, private equity firms, that's a way that they exit as well. So the IPO model works for a lot of firms, right? And a lot of firms need to raise that money. And so, yeah, but lo and behold, there is still a greater demand for direct listings than there were in the past. And it is something, remember, in the direct listing process, it cuts out a lot of the banks involved. And usually there's only a couple that really matter. So some banks are still very important in the process, and they do get a large amount of fees from these listings, but it is a smaller amount of firms. And then you have the roles of market makers like Citadel Securities that are playing a larger role here as well.
Bloomberg, Shonali Bossack, and Olivia Carville, thank you both for joining me. And now I want to stick with this general theme of IPOs. We have been watching WeWork officially hit the pause button on its IPO on Monday. In the meantime, the company is said to be exploring the sale of its minority stake in The Wing. That's a female-focused co-working startup. The Wing is both a WeWork competitor as well as one of its investments, known for its mission of women's empowerment. To discuss, I'm joined by Bloomberg Technology's Ellen Hewitt. Ellen, what I found really interesting is the co-founders wrote in their letter, "We want to get back to basics, focus on the core business." Is this part of that strategy?
I think that's kind of a puzzling question because when WeWork invested in The Wing, they led a round of about $32 million of investment in The Wing in 2017. And of all the investments that WeWork has made, this one makes a lot of sense. This is a different co-working model. It has a slightly more targeted demographic for its customers, but it's co-working. Talk about something that's really close to WeWork's core business, right? That would make sense. Meanwhile, the company has invested in things such as superfood companies, a wave pool company, all sorts of stuff that usually left company observers scratching their heads as to why that'd be an acquisition.
And not only co-working, which, like you said, is aligned with WeWork's business model, but it's supposed to be empowering a female working environment, of which WeWork had been criticized for having an all-male board and not doing enough to be, more inclusive. Does this not feel at odds with that mission as well?
I'm just reading the tea leaves out here. It does seem a little odd that this would be one of the first investments that they want to try to divest from. On the other hand, maybe this is something that is going to be just part of a pattern with WeWork where they're really, really cutting back, and maybe even investments like the wing that seem to make sense on its surface are not going to be aligned, not going to be something that they keep going forward.
We've also heard other rumors selling off a private jet that they have. That, of course, could make more sense from a pure headline perspective, let's say. Do we know how much money all of these investments are expected to raise?
I think that's also a big question mark. So a lot of these investments were, mixes of stock and cash, or some of them were all stock. Some of these we're talking about acquisitions as well as investments. So to be clear, the wing was an investment that WeWork made 2 years ago. Some of these other things we're talking about selling off were acquisitions, such as Meetup, Conductor, managed by Q. These are companies that were purchased by WeWork, became part of WeWork, that are maybe being sold now. And so it's unclear what sort of return WeWork is going to get on these. And I think the overall tone around it has been of questioning, wondering, is it really worth it for WeWork to even go through selling with these companies? They weren't huge acquisitions to begin with, so it's unclear how much they'll recoup from selling them off.
And do we have any indication of what those companies' reaction has been, like the wing or like another investment that WeWork has made in them, what they've been saying?
Not really, but I think with the wing, it has also been a question of, is WeWork more of a helper and an investor? Or is it possible that in the future they would end up being maybe too close and becoming competitors on a higher level? So I know, the women who run the wing are very ambitious and have a lot of plans for making this a huge network, not just of members who are part of their co-working spaces, but sort of a network of professional women. And so it's possible that, maybe the relationship was one where both sides were okay with the idea of divesting. But as we know currently, there's still a WeWork executive who is on the Wing's board. Her name is Jen Barrett. She's a longtime executive with WeWork, who's their co-president and has held many titles, including general counsel.
And as we know that WeWork is looking to raise cash by perhaps selling off some of these investments, how is the health of the balance sheet? Where do they stand in terms of cash on hand?
Cash on hand is running out. I think this is part of the pressure on getting this new loan, as we've reported. Instead of the $6 billion loan that was available to them if they could do the IPO, now it seems like they're in talks about a different $3 billion loan. They're just, they need cash to keep going.
New talks, new terms. Bloomberg Technologies, Ellen Hewitt, thank you for joining me. And coming up, do you know what the world's most used digital currency is? The answer may surprise you. We take a look at that next. This is Bloomberg. And now back to our top story, that leaked audio of Mark Zuckerberg from a company meeting that was obtained by The Verge news publication. During that employee gathering, the Facebook CEO is heard defending the company's controversial cryptocurrency, Libra.
The public things, I think, tend to be a little more dramatic, but a bigger part of it is private engagement with regulators around the world, and those, I think, often are more substantive and less dramatic, and those meetings aren't being played for the camera, but that's where a lot of the discussions and details get hashed out on things.
To discuss, I'd like to welcome Spencer Bogart, general partner at Blockchain Capital. So Spencer, you heard there, of course, Zuckerberg defending Libra. Generally, around Libra and all these cryptocurrencies, what is the general tone when it comes to working with regulators right now?
Sure. Well, keep in mind, in the case of something like a Bitcoin, there is no one to go and work with a regulator, and that's part of the point here. And I think highlights some of the differences in design that something like a Libra has, where it has to kind of go and ask for permission. Now, do I think Libra could be a very interesting project? Absolutely. Do they have their work cut out for them as far as trying to kind of appease all the various regulators? Most definitely.
So your analysis, which struck me, said that it would actually increase dollarization.
Yeah.
Why?
Sure. Well, if you look at the underlying Libra basket, right, they've published roughly what that would look like, and it's 50% USD. And if we think that a lot of the holders of this might be people outside the US, particularly potentially people, and again, the purpose here is to help unbanked populations, well, all of a sudden they would have an access to USD where they previously have not. So while many people in Congress, as you saw when David Marcus went and testified before Congress, many of the senators were concerned about whether this would lead to, whether it would infringe on the dollar's reserve currency status. And in fact, in the short to medium term, it would actually probably help cement that status.
And I think your takeaway, which seems smart, is that regardless of what happens with Libra, the general theme of this isn't going away, that there will be some sort of crypto or a coin or a currency that investors or people are looking to use instead of the dollar, right?
Yeah, 100%. I mean, I think in the case of Libra, right, it is still backed by all these fiat currencies, and I think we're going to see more efforts out there. So we see some of them from the large crypto exchanges like a Binance that has kind of a competing effort. And I think that we're going to see more, quote unquote, shots on goal here of people trying to roll out an effort like this, and maybe from someone a little bit less contentious than a Libra. But I still think Libra has a good chance of getting off the ground.
So another story that we looked at today was Tether. Actually, by trading volume is more than Bitcoin, even though Bitcoin feels sometimes as being more popular.
Yeah.
Why?
Sure. Well, I mean, two things to be helpful here is a little bit of nuance. One would be to define a cryptocurrency. So Tether is not really a cryptocurrency. Is it a digital asset or a crypto asset? Perhaps. But because it's backed by USD, it's a little bit different than something like a Bitcoin or Ether on the Ethereum blockchain, right? And then the second thing would be to define used, right? So Tether's main purpose is as a liquidity tool on top of exchanges and to facilitate the transfer of funds across crypto exchanges. So in that respect, its trading volume is a good reflection of its actual usage. In the case of Bitcoin, which is used as a digital gold, its trading volume is not necessarily indicative of its actual usage. I mean, I'm using Bitcoin today, but I have not traded it, so that's not accounted in that particular metric.
Has the volatility of Bitcoin push people into more of these stable coins?
I think so. So I think they occupy two different realms. So I think that people that are interested in investing in crypto assets like a Bitcoin, something that's perfectly stable would completely preclude the point of investing in it in the first place. But something like a Tether is very useful, particularly considering that a lot of traders in the space are dollar-denominated investors. So if their alternative is that they're trading some of these crypto assets against Bitcoin as the trading pair, well, that doesn't work as well if you're trying to denominate all your returns in USD. So something like Tether that's stable and where they can denominate the returns in USD is useful and does have a place in the ecosystem.
And broadly, from the regulation standpoint, where are we with Libra, Bitcoin, Tether, the difference between all of them and different regulations potentially for all of them?
Sure. So Bitcoin is at the safest end of that spectrum. It's one that securities regulators have been very clear that this is not a security. So it is much closer to a commodity in that respect. So its regulatory status is in the clear. Something like a Tether is somewhat uncertain at this point. It is regulated, I think, by certain offshore entities, but not necessarily by the U.S. The New York Attorney General has been leaning into that a little bit more. And then something like a Libra is very uncertain at this point, right? So, I mean, we're still waiting for kind of final design specs and waiting to see what happens kind of in those conversations with regulators.
Across the whole gamut. Yeah. Spencer Bogart of Blockchain Capital, thank you for joining me. Now, on Tuesday, UPS announced a milestone in its development of drones used for delivery. Bloomberg's David Weston spoke earlier with David Abney, chairman and CEO of United Parcel Service, and asked about the approval by the FCC and why it's so important.
It's high value add, but time is of an essence. And so some of these big hospital campuses, it can take you 30 minutes to go from one end to the other because you have to go around the buildings through red lights and busy streets. What this allows is in a matter of just 2, 3, 4 minutes, we can deliver, a hospital can take a blood sample, we can deliver it to the lab in 3 or 4 minutes, and that just saves so much time that could take just hours previously. So that's why we started out here. But let me give you a life and death type example that could happen. And we'll use WakeMed Hospital as an example. They have multiple clinics around the Raleigh area for snakebite venom, anti-venom. They may have just one dose because it's so expensive, is not used frequently, and it expires and it's no good. Now they can have that one dose no matter where the patient comes in. we can deliver it to the facility the patient is at in a matter of minutes. So that could be an actual life and death situation. So we're excited about that too.
You mentioned this gives you permission beyond line of sight. Does it give you permission between campuses of different medical facilities? I know some of these medical facilities are vast. That's significant in itself. But can you go between campuses?
Yes, we will be able to go between campuses, and that is one of the very interesting parts of this. And then as the FAA finishes the regs, continues to write the different regs, we'll see different applications, including at some point we will see at-home deliveries, especially in rural and suburban areas. So we're excited about where we are. We're way ahead of anyone else, but there's much more to come, and UPS is going to lead the way.
Well, give us a peek into that, because we talked about healthcare. That's high-value product, and as you say, there's some urgency attached. What's the next area you anticipate moving into that makes sense from a business point of view for UPS?
You know, well, first, when it comes to healthcare, we expect to be in, we're in one now, WakeMed. We expect it to be in dozens and then over 100 sites. So there's a lot of expansion in healthcare in different products. And then we will look at other campus-like environments, whether it's education or other large corporate office type situations where you can have that same value proposition. And then, of course, we believe that at some point, and when the regs are written, that we could take a UPS package car, and as the driver's delivering their route, have a drone docking station at the top of the car, and the drone just continues to meet the package car and maybe delivering it the outer loop at the same time that we're delivering. So there's all kinds of potential that we can enable our drivers with.
That was UPS CEO David Abney with Bloomberg's David Weston. And still ahead, shares of the biggest online brokerages plunged today after Charles Schwab announced plans to get rid of commissions for online trades. We have the story next. This is Bloomberg. Shares of the biggest online brokerages plunged on Tuesday. That was after market leader Charles Schwab announced plans to get rid of commissions for U.S. stocks, ETFs, and options. It's the latest shot in an escalating price war. Schwab rivals like TD Ameritrade and E-Trade will be pressured now to make their own cuts. To discuss, I'm joined by Bloomberg's John Gittleson in Los Angeles. John, we've been talking about this fee war for ages. Is Charles Schwab playing catch-up here, or are they leading the industry on this?
Well, they're saying that they're feeling pressure from newcomers to the neighborhood. Companies like Betterment, Wealthfront, Robinhood, those sort of robo-advisors, they're offering all kinds of free services. And so Schwab is saying, this is going to happen eventually anyway, so let's get ahead of it. Why wait, was the words from the chief financial officer of Charles Schwab.
But John, how long can all of these companies survive if I'm not paying to use them?
Well, that's a really good question, and we'll see. I think there's going to be a lot of consolidation in the industry. The ones that can't figure out a model to survive, they won't survive. We don't know. E-Trade has talked about being a target for acquisition for a long time. Schwab has other sources of revenue. It mainly operates like a bank and gets the majority of its income from net interest margin. In other words, a lot of its account holders have cash accounts, and it makes money on the interest spread.
Well, and along from consolidation and net interest margin, as you mentioned, what other sources of revenue could we expect to see given the race to zero with fees?
Well, a lot of the asset managers want their funds listed on Schwab, so they charge fees for that. And then there are other services that they can charge fees for, like advice, although that's getting very competitive too with the robo-advisors out there. And then there are all different kinds of like lending, security, margin trading, options. There are more advanced type of securities. If you short shares, people pay to borrow shares in order to short them. So there are other ways that these funds or firms can make money, but everything is getting squeezed.
You know, John, you've been covering asset managers for years and years. How did this whole thing begin? Was it the move to passive, the rise of ETFs? How did we get to the place where consolidation and other sources of revenue is the only way for some of these companies to survive?
Well, it actually dates back even further. If you go back to the 1970s, Charles Schwab itself started off as a discount broker. When the SEC said there are no limits on commissions, a lot of Wall Street firms said, let's raise commissions in that case. And Schwab said, no, let's cut commissions. And that's how they started getting business to begin with. And so their whole history has been cutting fees. They have what's called the virtuous cycle, where they say, we cut fees, we cut expenses for consumers, we get more consumers using our services, and we are able to increase our overall revenue by having a bigger pie, and that rewards our shareholders. And it's gone up and down, but so far it's been paying off.
And quickly here, John, the consumers win. Who loses?
Well, the people who lose are the people in the advice, asset management, and stock brokerage industry. Those guys who, many of our viewers, are out there making their money off securities. They better, consider, what is the future of my career?
Bloomberg's John Gittleson, thank you for joining me. And that does it for this edition of Bloomberg Technology. And Bloomberg Technology is live streaming on Twitter. Check us out at Technology. Be sure to follow our global breaking news network at TikTok on Twitter. This is Bloomberg.